Good morning and welcome everyone to the Moneycontrol live stream. You're watching the opening bell and I'm your host Nickey Mirchandani. Well, festive greetings out there to all of you. Indian equities are set for a positive start thanks to positive global setup. GIFT Nifty indicates a fairly modest start coming in for Indian equities. And talk about US market, it shut shop higher for third consecutive session. Higher perhaps on weak monthly job opening, which raised in expectation of an interest rate hike pause by the Federal Reserve. Asian shares hit two-week high early this morning on Fed pause bets along with China boost. FII and DIIs too have participated to the positive sentiment. FII bought shares to an extent of 61 crore and DIIs too have been buyers to an extent of 305 crore for Indian equities. In terms of trade setup that we have in terms of the stock setup, let's look at the highest delivery interest. Infosys, Alchem Labs, along with SBI Live, Bharti Airtel and Ultratech are some of the names which are featured in the list of highest delivery interest. Stocks where there have been long build-ups which have taken place. Deepak Nitrit, Ashok Leyland, Jubilant Foodworks, TVS Motor Company and NTPC. In terms of long unwinding, Ipca Lab, Bata India, Dr. Path Labs, ICICI Lombard and India Mart. These are some of the names out there. In terms of the short build-up, Aditya Birla Capital, Balrampur Chini, AU Small Finance Bank, HDFC AMC have also featured into that list. Interesting bets coming in even for the short covering activities. Persistent System, Coforge, essentially India Cements and Ultratech Cement are some of the names out there. In terms of the FNOQs that we have, FIIs, they've been net buyers in index futures, sellers in index options and also have been buyers for stock futures. Along with that, they've also been buyers in Bank Nifty futures and options put together. Let's talk about the stocks which are in FNO ban. What still remains in ban? Escorts, along with Hindustan Copper, Manappuram Finance, along with GMR Infra, RBL Bank and Sun TV they're still in the FNO ban list along with India Bull Housing Finance. What comes out of the ban? BHEL and India Cements. Let's actually address in the trade setup further in detail. And to take the discussion forward, we're being joined by Rajesh Palviya, Senior Vice President at Axis Securities. Morning there.
Good morning, Nickey.
How are you looking at the trade setup right now? A bit of strong positive opening coming in for Indian equity markets. It's been stuck in a very tight range in the entire week. But do you see, more upside to the Nifty and Bank Nifty here on?
Yeah, so index is stuck in a range, but broader market is performing. Stock-specific action is happening in the market. But yes, looking at the near-term setup, we do expect that towards the expiry for this August series, some recovery trade is going to take place for the Nifty also as well as for the Bank Nifty. We are expecting that this move can extend towards 19,450, 460 level. So one can buy a 19,350 call option, which was closed at around 51 rupees and projecting target of 110. Keep a stop loss of 25. For Bank Nifty, we are expecting that this momentum can extend towards 44,800 to 45,000. So those who are holding the long position can keep now their trailing stop loss towards 44,300 to hold their long position. So both indices have witnessed the short covering action in the previous session, and we do believe that some more traction on the buying side we can witness in the today's session also. So hold your long position for index.
Okay, so long position coming in for Nifty and Bank Nifty, immediate technical levels, the index, perhaps Bank Nifty, do you think it faces a resistance obstacle at 44,650 level?
No, I think Bank Nifty may able to give breakout above 44,650 and then possibly this rally can extend towards 44,800, even 45,000 because short covering was there in the previous session and that same behavior we can expect in the today's opening also. So hold your position and keep trailing your stop loss on the higher side. So Bank Nifty is looking promising out.
All right, that's the word coming in. Let's address the market opening for AO. We're looking at gains, 0.4% out there, 19,400 mark, well above that level, comfortably sitting around that level with gains with little less than 0.5%. Bank Nifty at this point of time is also trading in higher and gains to an extent of 0.4% for Bank Nifty. Nifty was closely around that level to 44,600 mark 650 mark, well above that level for Bank Nifty. Small cap index and mid cap index. These are another one where mid cap index is clocked in gains in early deals to an extent of 0.6% and small cap index is seeing a bit of outperformance coming in, and we're seeing gains to an extent of 0.75% out there for small cap index. In terms of what we have on sectoral indices front, we're looking at IT, and IT is doing well, 0.75% of gains coming in for the IT index too. And pharma seems to be doing well. Pharma is witnessing gains to an extent of 0.5% out there. And in terms of other defensive names like FMCG, holding up well in trade, gains to an extent of 0.3% for FMCG basket too. In terms of the rate sensitives that we have, something's in the like of realty index, auto index perhaps, and then perhaps metal index also seems to be doing well. That needs to be addressed too. Auto index in top gear, it's perhaps many consecutive sessions of gains coming in for the auto basket. Metal acts no differently. It's seeing gains to an extent of 0.4%, and realty index outperformance coming in on that one. More than 1% on realty index. Let's look at the top gainers and the top losers that we have on the list just to see how the trend is shaping up. Hindalco, Tech Mahindra and UPL. These are some of the top gainers that we have, along with HCL Tech, Infosys and Axis Bank. Essentially, it's the IT stocks which are doing well. In terms of what we have in terms of top losers, just to see where the trend is shaping up, market threats right now, 45 advances to 6 declines. BPCL, Power Grid, Moto Corp. These are some of the top losers that we have on the list. Adani Enterprises, Apollo Hospital and Asian Paints too are some of the top losers that we have. In terms of what I'd like to address in stocks and news, Zomato there, where SoftBank is going to be offloading in 1.17% stake overall in the giant, and the transaction is expected to take place via block deal to an extent of 940 crore. 10 crore shares will be sold, and this will be at a price of 94 per share. HSBC has come up with a report on Zomato and raised the target price to 120 from 102. It talks about the hyper-local business, which raises the conviction overall on the long-term financials of the company. Speaks about Blinkit earnings, which is also expected to lead the revenue front for the company, and essentially the brokerages think the hyper-local can be much of a bigger business for Zomato. A word coming in on that one. Brokerages are bullish. Block deal is expected to take place. The stock is up by 4.5% in early deals. Piramal Enterprises, downgrade coming in by Citi to sell rating. The target has been cut to 1,010 rupees. The target to double AUM and the scale ROAs, ROE still is modest given the kind of transition risk that the company is witnessing, Piramal Enterprises. That's what Citi has to say. It also speaks about the retail business, that being a little more competitive, and the wholesale AUM business, which is essentially non-interest bearing, may weigh on the NIM performance of the company. Brokerage Citi also sees some early concerns in unsecured lending. Overall, it's a bit of negative priced in for Piramal Enterprises, but the stock right now is flat, perhaps with gains, slender gains that you can see on the screen there. Moto Corp, it's a sell rating coming in. Number of brokerages have covered the stock today. It's a sell rating for this one by UBS, where the target is at 2,650. The company is going to be launching in Charisma XMR 210, which is expected to revive the premium portfolio. The fully fed bike segment is expected to launch 1% to 2% to the overall EBITDA performance. And brokerages essentially feel that the investor optimism on launches seems to be overdone, and the risk to core business still persists. Essentially, on back of that, there is a sell rating coming in for Moto Corp. And also APL Apollo Tube, where the promoter has been offloading equity. It's completely exit. Rahul Gupta has completely exited out of the counter by selling in the shareholding of 0.5%. The sale has been done at an average price of around 1,620. You can see a little bit of downtake coming in for APL Apollo Tubes, relatively a mid-cap name out there. but one that needs to be on your watch list. I'm going to come back to you, Rajesh, and check with you. What do you make out of the IT stocks essentially? They've been the top gainers. Anything that looks attractive, and also one recommendation for our viewer out there?
So emphasis is looking promising from mid-cap IT, and we believe that this stock can exhibit furthermore upside from the current level. Though we have seen some corrective action, but stock is on a verge of giving breakout on the chart. So looking at the setup, we expect that emphasis can continue furthermore upside. 2450, 2500 could be the possible target on the higher side, and keep stop loss of 2290. The another stock from midcap IT, that is Birla Soft, is clearly showing a strong buying action, and outperformance is there. So Birla Soft is another stock that from midcap IT we expect that this stock can move further higher towards 520, 530 on the higher side. So one can look at Birla Soft to buy at the current juncture. The stock pick which we like post opening, that is GNFC. Very strong buying action in last 2-3 trading sessions. And now looking at the setup, we expect that this rally can extend towards 630, 640. So GNFC one can buy and accumulate with stop loss of 595.
Right, that's the recommendation, Birla Soft and GNFC. But we're just going to leave it at that. Rajesh, thank you so much for taking out the time and speaking to us.
Yeah.
All right, let's also address the fundamental side of the story, and how essentially FIIs have been behaving, retail investor, and their soaring participation, or rather just say the revolution that we've witnessed across the retail community for the last couple of months, to be precise. But to take the discussion forward, we're being joined by Ihab, Dalwai, ICICI Prudential AMC. Morning there.
Hi. Good morning.
Pleasure to have you with us. Essentially, I'm going to check with you about the volatility which has taken place in the index typically in August, but the investor participation that has remained higher, with the combined average daily turnover now hitting at a fresh 22-month high. Does that concern you, given the kind of retail behavior that we're witnessing and the conviction that we're seeing within the community? Does that worry you at all?
Yeah, hi. See, broadly, if you look at the market on a broader perspective, when you look at it from capitalization perspective, especially large caps currently have underperformed mid and small caps. And it's not only an August phenomena. If you look at for the last 3 to 4 months, the risk or the implied volatility or implied risk which we are seeing in mid and small caps have dramatically reduced. And from that perspective, primarily it is because of, like you mentioned, higher participation from domestics as well. And secondly, obviously, the FIIs have also come back. From a margin of safety perspective, I think large caps provide a margin of safety today versus mid and small caps. I think the risk implied volatility is very low in mid and small caps. Therefore, which should not be the case, because generally mid and small caps are expected to be more volatile than Nifty. But in today's environment, that is not the case. So for us, I think one should have some caution in mid and small caps today versus large caps, and there is margin of safety today in large caps.
All right, margin of safety for large caps, but a bit of volatility, do you think is perhaps overdone now in the entire space that we're looking at for the mid cap? They're at record high. Do you think it's the rally is overdone? Retail participation is perhaps more in small cap and mid caps as the trend has stacked up until now. Are you also as bullish on the mid cap broader segment as compared to that of large caps? What are you suggesting to the viewer, to your investors out there?
So like I mentioned, the preference is for large caps. Mid caps obviously are trading at higher valuations versus large caps, though the implied growth is expected to be slightly better in mid caps. But currently, the current definition of mid caps is also slightly narrow, of 150 stocks. And as a result of which, there is decent AUM or decent money which is chasing these 150 stocks, and as a result of which, I think the valuations on the slightly higher side. So if one is looking at sectors where there are large caps available as well, I would recommend, or we are trying to position our portfolios in a way that it would be in the large cap names. So valuations of mid caps is on the higher side. The interest, like you mentioned, is also on the high. And as a result of which, in case there is some disappointment in terms of corporate earnings within mid caps, or maybe some global led risk aversion which can come or may come, can lead to some correction, as a result of which the preference is for large caps today.
All right, as a fund house, directionally, where the markets are headed, what are you suggesting to your clients? Because there is a general perception right now amidst both the institutional as well as retail category that the market is not going up anywhere soon. But there's a bit of outperformance which is coming from the defense pockets typically, which seem to be an exception so far. As a fund house, what are you recommending?
See, broadly, the view is that we would be in a muted return environment currently. Typically, a market return expectation is a function of your earnings growth and your multiple re-rating or de-rating. So when you look at from the multiple perspective, we are today at a slightly higher than the average multiple for the large caps. And the earnings growth expectation is also is close to nominal GDP. It's not the expectation is not that corporate profitability is expected to grow at a significantly higher pace than nominal GDP. So as a result of which, if you multiply the two, there can be some derating also for the market. So as a result of which, the market return expectation should not be pretty high. On a best case basis, I think one should have a nominal GDP as a market return expectation, because corporate profitability also would tend to follow that.
Okay, so what kind of returns are you even anticipating or projecting for the year end? Which direction do you think, are you expecting some amount of correction to come in for Nifty, a sharper one perhaps, before we could kind of see a bit of structural bull run which is at play? Do you anticipate moments of correction, and if yes, is there a near-term projection out there?
So it'd be difficult to project how market market returns would play out in the short term. But if you look at Nifty as well, Nifty return has been slightly muted over the last 1 month, predominantly reflecting the large caps. Like I mentioned earlier, it has to be the return expectation in the near term has to be muted, because you are starting. If someone's looking to invest today, is looking to invest at an elevated multiple. And unlike last year we had a very strong earnings growth recovery, primarily because the last year had a very good base effect of COVID. So corporate profitability growth was pretty good. But this year, I think base is also strong. And like instead of looking at market on a whole, one will have to do, I think, bottom-up sector-specific views, or will have to take such views to figure out which sectors would outpace market growth. And out there, we feel that there is some pockets of growth which is visible in autos as a segment. Power as a space is also expected to do well. Telecom as a space is also expected to do well. So one will have to find out sectors or stocks on a bottom-up basis to identify segments of the market which will end up doing better than the broader market.
So what, according to you, which theme according to you is the alpha generator? Also talk us through IT stocks, which have been a bit of underperformer, but in today's session seem to be the top gainer. Mutual fund houses also are pushing out tech funds, especially when IT stocks are in doldrums. How are you looking at it?
So yeah, like I mentioned, that there are a few sectors or segments of the market which we currently like or are positive on. Like I mentioned, autos is one segment, and within autos, it is predominantly passenger vehicle and two-wheelers. Tractors and CVs are somewhere closer to the mid to peak cycle, so we find comfort within two-wheelers and four-wheelers currently. Apart from that, pharma is one segment which I said, and last quarterly results also demonstrated that there is good recovery in the global pharma market for the Indian pharma suppliers. And not only North America as a market, but rest of the world is also doing well for these pharma companies. Domestic Indian pharma market is also expected to look good in the near term for pharma companies. So these two sectors is something which look good from a near to medium term perspective. Coming to your point on IT, I think over the last couple of quarters, what we have seen is that IT earnings growth expectations have gone through a normalization phase. If you look at the net hiring number also, there have been three continuous quarters where we've seen a negative net hiring for the listed space as a whole, which is a rare phenomena. And as a result of which, one can expect that the earning expectations are normalizing. A lot of these IT companies, at least the large cap ones, have tapered down or brought down the guidance of earnings growth or revenue growth as well. So which again reflects that the earnings expectation is normalizing, is becoming muted. And IT multiples also, be it through free cash flow yield or dividend yield or even PE multiple, are trending towards the long-term averages now. So there is it is slowly and steadily becoming a good case for investment from a medium to long-term perspective, as multiples are close to fair multiples and earning expectation is muted. So any positive or earnings surprise on the positive side can lead to good share price reaction.
What's your reading on the new age stocks? A couple of block deals, perhaps SoftBank is selling out today. When it comes to the Zomato, block deal is expected to happen 920 odd crore, 1.112% stake in the company. For the new age companies, something in the like of Paytm, Zomato, Delivery, Nykaa. How closely are you looking at them, and are you also suggesting your clients to invest? Do you have the exposure of these stocks in your portfolio?
Few of our portfolios have exposure to a few of the new age stocks. So predominantly these are digital first companies which are catering to basically they are catering to certain demands which are not met by the offline platforms. So as a result of which, one has to think of these businesses in a different way, because each of them is pretty unique and is catering to each different customer segments. So one has to understand the industry dynamics for each of them separately. So what has been the case over the last 1 year for most of these companies is that they had to choose between growth and profitability. I think post listing, the focus on profitability has taken, I think, the front seat for a few of these listed new age companies, I think, which market has appreciated. But from a medium term perspective, I think that is a good thing. But obviously, one has to take into consideration the total addressable market which these companies can cater to, and should try to identify whether the current valuations also justify that addressable market. So broadly, I would say that one has to do a very bottom-up company-specific analysis on each of these companies. Should not invest in them as a basket, because they're pretty unique businesses catering to very unique customer requirements. But within them, there are good business models. Few of the companies operate in a duopoly environment as well, which is very good from a conventional industry structure perspective. And it is now up to them how they use the industry structure to improve their profitability as well.
Right, Mr. Dalwai, we'll just leave it at that. Thank you so much. Appreciate your time early this morning.
Thank you so much. Thank you.
Let's talk about Rishabh Instruments and the IPO, which is open for subscription August 30, that's today, and was going to be closing for subscription on 1st September. Price band for this particular company's IPO is to an extent of 418 to 441 per share. Issue size is to an extent of 491 crore, and the market capitalization for the company is 1,674 crore put together. How does it intend to utilize the proceed? Essentially, out of the OFS issue consists of 75 crore fresh issue, and OFS is to an extent of 416 crore. The financing, essentially, it's financing the cost towards the expansion of Nashik manufacturing facility. A bit about this company: it's the energy efficient solution company which is engaged in the business of designing, developing, manufacturing and supplying electrical automation devices along with metering, control and protection devices. A host of products out there when it comes to the company, but the company in terms of the financial performance has recorded a healthy top line growth, with revenue from operation growing 21% to a number of 570 crore for FY23. Profits have come in at flat 49 crore against the same figure that we've seen in FY22, impacted by weak operating margins given the high input cost and employee expenses. But we caught up with the management, and the management has projected by FY26 they expect the number of top line almost doubling up from 560 crore to 1,000 odd crore company by FY26 is a projection coming in by the management. But with this, it's a wrap and goodbye from the entire team who puts this piece together. Thank you so much for watching. Please do post your feedback for us in the comment section below. Follow us on the link at the bottom of your screen, and for rest of the updates, stay tuned into moneycontrol.com and Moneycontrol app.
How do world leaders view India?
I've long believed that the relationship between the United States and India is will be one of the defining relationships of the 21st century.
The bright spot of the global economy.
The growth rate for India, which is 6.8 in 2022. Let's not forget, this is one of the bright spots in the global economy right now, such a high growth rate.
The potential of India is enormous, and you have now a reformer, a radical reformer, who has the ability to transform it.
On the verge of a big transformation.
इस अमृत काल में हमारे संकल्पों की सिद्धि हमें आजादी के 100 वर्ष तक ले जाएगी.
A magnet for investment.
I'm actually incredibly excited about the future of India. I think India has more promise than any large country in the world.
The world is bullish on India. Moneycontrol is bullish on India. Join the campaign. Tweet to us with hashtag MC Bullish on India.